All right, good evening, ladies and gentlemen. This is Clueless A Trading Frank. We're here for a quick and constructive market update webinar, mostly on the tactical chart side, and a couple of comments on the market. This session will be recorded and uploaded to the YouTube Clueless 8 YouTube channel, which you can view at any given time. Go ahead and make sure that you subscribe to that to the YouTube channel so that anytime anything I post you're directly notified via email automatically. Full disclosure, this is purely for financial education and not for any solicitation or advice. So let's start. First and foremost, a couple of quick comments on the market. Just make sure that you guys can see the visuals behind us. I'll go through some of the technicals of what we're seeing and what some of the predictive forecasts are for the remainder of the week and for the remainder of the month, which we're coming up pretty fast. We just have a few real trading days left, and I can assure you that it's not going to be quiet. All right, that's for sure. There might be light volume, but it's certainly going to be pretty dramatic and at the same time quite volatile. So the comments, one of the key comments that I want to make is specifically for traders, is that what the market's doing right now is nothing out of the ordinary. The upside bias is intact. There's no question about it. Regardless of what the media says, regardless of what your cognitive bias is, that we should not be here and the markets are overvalued and all that gibberish that you hear about. The reality is that the market right now, it does not care about fundamentals. This is not a valuation driven market. This is a market driven by momentum, and momentum markets will follow tactical patterns and a momentum biased indicators that will hopefully tell us where we're heading. So far, my projections all the way back from the days of it seems like years ago, which was only a little bit more than a month ago, from the elections, it has come to fruition. It hasn't been an easy ride in the sense that it's nothing. And as I like to point out every single time, and I hope people, traders start to believe that themselves, that markets are not linear. They don't go up in a straight line. They don't come down in a straight line, regardless of what the events and the dynamics are in the market. They're algorithmic markets driven by algo HFT programs. That's short for algorithmic high frequency trading programs. These are black boxes which basically are programmed. And not all black boxes are the same. Just like human traders, there are many different stripes and styles of black box trading or HFT trading. But the ones which are very active in the market on a daily basis, in fact, almost 80% of the market volume on a certain day, especially on volatile days, are driven by these black boxes. That they follow a very algorithmic pattern, and that's really where the strength of Clueless A Trading comes in. Every single morning, every single day throughout the day, I show some very critical inflection levels on the market, which are met and hit pretty much 90% of the time. So this brings me to a very important reminder to all traders that those inflection points and levels and the lines and everything, and even the numerical numbers that I post on the real-time Twitter feed, that's where all my content is delivered, are meant for you to use and utilize in managing your trades. So if you have a bunch of options on Google and the thing is up $6 and it hits one of the first levels, well, you don't sit around and daydream and think that it's going to move up to the second level without any resistance or without any fluctuations or without any volatility. Because it seems like that human traders repeatedly, and this is not just one person or two people or thing, but human traders in general, and specifically retail traders, seem to believe in some sort of they just don't seem to believe in the fact that things don't go up in a straight line. You will arrive at that zone. We will hit 20,000. I'm almost 80% or more convinced of it. Even if it's for a touch, they will hit it. I mean, come on. We're only less. I mean, at one point we were 50, 60 points away or 90 points away from 20,000. Now, will this 20,000 change the whole face of the world? Absolutely not. It's just a psychological number. I've shown and I'll show again that the actual tactical number on the markets is actually 20,127. So go figure. But the point is that what I tend to find, and I'm not blaming anyone, I'm just saying, and look, I'm human too. It gets frustrating when you see it almost there but not there. The fact is that you have to, those inflection levels and every single point that I draw, these charts are not drawn for fun. They're drawn to help all of you. It's drawn and structured to help me navigate any type of market, and all markets are volatile. Less volatility or high volatility, but they're all volatile. So the point is that these levels are drawn so that you can track on your side within your time frame, within your means, of your day jobs and stuff like that. But in order to manage your trades in an effective manner. That doesn't mean that, it happens to me all the time. You take a bunch of profits on movements first part of the day or midday, and then you go into some selective positions, after you sell your profits, and those are down. At least, for the P&L is down on those on the second lots of these positions, let's say, by the end of the day. It doesn't mean a hill of beans, because the reality is that you at least captured profits on the first lot of trades that you did, which we did. Multiple trades, whether it be the SPX, whether it's Google, whether it's Apple, whether it's Amazon, whether it's Tesla, whether it's ICPT, giving you some specific names that were recommended just since Friday. So it's up to you to manage your trades. Now, if you sit around blindly and you think that, you shouldn't be taking some profits off the table, and I alert people straight out that, the trading positions, lowering down trading positions, selling 70% of the trading positions, those are just actual direct signals that, hey, try to take some partial profits off the table. So what I find is that many of you don't, and it's borderline ridiculous if you ask me, because all I'm trying to do is help. So what I'm getting at very simply here is that these tactical levels, every single one of them, and if you look at this chart, in front of you, for example, of the Dow Jones Industrial Average, look how precise this is. A chart alone means nothing. It's the structure you draw on it is what matters. For that alone, I should be getting a gold medal, because these structures were drawn from days and days ago and are tweaked on a daily basis. So tactical traders, and you don't need to be a rocket scientist to be a tactical trader. All you have to do, like I say, I do the hard work of structuring it. All you have to do is focus. At least look at some charts on your side, hopefully similar to the ones that I'm doing. So in that case, use at least one of the platforms that I'm using. This is a free one, investing.com. I don't pay them a single dime. And it's terrific, because then you can actually get the feel of what's going on. So I do the hard work of showing you and structuring it the way it should be structured, the channels, the downtrend lines, the trading ranges. So you do what you need to do in between. Is it a perfect science, trading? Never. Anyone who tells you that is a liar. Trading is not a perfect science. You try to do the best from within the ranges that you're trading in. So you get this massive move. For example, today's the 19th, right? Okay. Yep. So right there, and you get this massive candle. S&P calls first part of the morning. They go from $4 to almost $7. So what are you going to do? Sit there. You're going to see this. You're going to watch the fact that I've already drawn it. I've already shown it. It hit the first channel, couldn't break through it, pulled back and did an exact reversal. This was a 1, 2, 3 candle move, 3 large candle move. And this was a 1, 2, 3, 4 candle move, exactly down to the lower channel. Right at that lower channel, it's not that life is ending. It turns around and goes up, tries to engage the downtrend line again, this red line, which is pretty obvious. Fails to do that, pulls back. Multiple news events, all kinds of stuff obviously rocked the market. The tragedy in Germany, the shooting of the Russian ambassador, which I really don't give a hill of beans about. That's it. That's a political killing. That's not going to affect us whatsoever. The tragedy in Germany, we don't know exactly where it's coming from, but looks like a terrorist incident. So obviously, it's a cause for concern. And our condolences go to every single innocent being who died in that truck attack. But the fact is that you have to, so all these things, they're coming in waves in the market. Uncertainty whether the Electoral College would go ahead and do their job, which they did. Congratulations to them. It's all done deal, right? Because you don't want political uncertainty in the U.S. That's what drives markets nuts. So all these things, waves are coming, but that's not really what's driving the market. What's driving the market is actual tactical levels of where it's going, grinding, moving, throwing traders off kill and off the track. And then it's going to break out. I have, from looking at many, many different things, and I'm not going to go into everything today. You want to know the exact details and the mechanics and the hardware of how these things work, sign up for the advanced coaching sessions. I'll be more than happy to spend my, family time. And some of you here know that well. You've taken with me. They work. And you learn how to really be a true technical trader. And you practice and you practice and you get better and better. I still do, learning, practicing, moving on. So the bottom line is that at this point, my opinion, I believe that we are going to enter channel number 2 this week. Because the pattern symmetry dictates, which I'm going to get into in a second, that this pattern here, from all the way back there, the zigzag pattern is really a very large, complex inverse head and shoulders with multiple small patterns in between. So in summary, what I do want to remind everyone in a friendly but firm way is that if you're not really tracking the charts, and you don't need to really track it, you just have to understand the levels that I'm putting out there. It's all visual. I'm showing it clearly. But if you're not managing your trades within those ranges, there is no one to blame but you. Take personal responsibility. Go do what you need to do and discipline yourself to manage your trades. Take your profits when you have to. Stay in the trade if you need to. And most importantly, take personal responsibility. All right, and that's it. I'm saying this, and I'm saying this very sternly. All right. Now, let's take a look at what's going on here. You have a very, they say there's no volatility. Everyone's complacent. That's what you hear in the media, right? VIX is at 11.71. You really think that this chart from the 15th? Okay, let's take a look at it. Let's take a look from the big phenomenal drop that we got, from the 14th. Does this chart really look like it's a complacent market, that there's no volatility? Last I checked, and even a second grader would tell you that when you do this stuff, skipping in between what I call channel surfing and doing this stuff, this is not volatility. This is extreme volatility. Yes, in a tight range, I admit. It's not 300-point volatility type of stuff. But this is volatility. So when you hear the media guys and the gurus in other forums telling you that everyone's complacent and no one really is worried anymore, they're all lying. They're all lying. Because if you look at yourself and you look at the overall feeling of the general traders, everyone's nervous. Everyone's nervous. The bulls are doing the talk but not walking the walk. And I mean that. The bears are terrified because every time they're trying to short the market, it's not breaking. And the algo HFT programs are having a field day, messing with your heads. So in order for your head to be less messed up, try to focus harder. I'm doing the hard work, like I repeat, of putting all this stuff together. Intraday, there must be at least 25 charts on individual stocks and the market, completely keeping you updated every hour, every half hour, or less. Actually, less. So all you got to do is open your eyes, click on those 3 brain cells that you still have left, and manage your own book. Doesn't mean you're going to be green by the end of the day. It doesn't matter. But the fact is that you don't need, your P&L doesn't have to be green every single day. That day trading myth is a joke, in my opinion. You want to make real money, you position yourself, you sell what we call shooting fish in a barrel. How many times have we done that? Multiple times. Gap open, big, Amazon up 12 bucks from the original trade, 15 bucks. Take it. But then you have to position yourself on those tactical lows in order to do that. Case in point, Friday. People didn't want to touch Amazon. I kept on showing it was going to hit the first. It was going to hit a multiple support level at around 754, 755. Gap fill at around 760. A positive divergence that was happening underneath. That positive divergence played out today. I mean, even on the pullback, the stock was up 6-8 points. And at that height, it was up, I think, 12 points. What more could you ask for? Okay? So ask yourself these questions and improve yourself on a daily basis. Markets are not linear. They're algorithmic. Get used to it. And if after all these months and after all these years, if people are still learning, and especially with people who have been in my service for anyone who's been with my service for more than 6 months knows exactly what I teach, what I preach, what I take the time to make people understand. And even after that, if you don't get it, then don't be a trader. Honestly, I'm just saying it straight out. And I'm not, man, because I have no fiduciary responsibility or anything to how you guys manage your money. I'm just giving you the straight facts, straight through your head. So get with it. Enough excuses. So saying all that, this is intense volatility. But in between, you get multiple opportunities. And as you know, we're long short with a long bias at this point. But we're long short traders. You can clearly see that these markets are offering multiple opportunities. Not easy. I'm never going to say it's easy, but not that impossible either. One of the key things about machine-driven markets, which they are, is the fact that they tend to, the liquidity pump and dump that algos do happen very quickly. So that I'll give, in the sense that things happen so fast, within minutes, because algos are operating in nanoseconds, right? So that sometimes it's difficult to react right away. That I admit, that I give. But when you look at charts like this, in the simplest basic terms, you see a channel low, you see a reversal candle developing, or a bullish engulfing such as this, engulfing the previous red bar. And if you are at your machine or at your disposal, you can trade, then act on it. If you're an SPX trader or a RUT trader or an index trader, or you do it as part of your trading regimen, then you can jump in and out in 15 minutes. Sometimes less. I don't make these things up. Blame the algos for the speed. You buy something at 3, you can sell it at 4, 4.5, 5. It's like buying a stock at 3 and going to 5. It takes months for stocks to do that. In the case of SPX calls and puts, they happen within 15 minutes, 30 minutes, an hour. And you all know that. But when you see something like that, you don't, of course, I'm there to alert, but humanly, it's not possible for me to give every single alert on every single twist and turn. That's why I say focus on the charts. What's so difficult? You get a move down here. You can clearly see here we have multiple lows. Support levels here on this particular lower channel or uptrend line, if you want to call it that way. How many times? 1, 2, 3, 4, 5, 6, 7. Gotta give it. The channel's holding. So once you get down there, you go in. Now, it's not just for SPX, and this is obviously the Dow Jones, but not just for SPX trading or SPYs or IWMs, RUT, but this allows you to get this. This is a trade management tool, because even if you don't trade the indices, you know that when this is happening, your Googles, your Teslas, your whatever that you're trading, especially high momentum stocks, are coming down too. So you use this as a proxy to manage that particular trade. It gets up there, you have some nice profits or any profit, you might want to take it. If you don't want to take it, you want to be like a swing trader, and you say, okay, channels are holding, looks like the market does want to go towards 20,000. Good. In that case, be a swing trader and don't look at the market every 5 minutes or 10 minutes. Remember, every trader thinks swing. I mean, a lot of traders do in a swing time frame, but they act like monkeys on a hot tin roof every 5 minutes. So what gives? We're all guilty of that, not just you guys, but some of you guys do it a lot more. So saying all that, I wish you all well and good luck and focus. So these channels are intact. It looks like the market will break out over this channel, and I do believe that we hit the 20,000 mark by sometime this week. We got close to it. There'll be grinding action back and forth. We'll get to this channel here, upper end of this channel, and then it's going to pull back. Now keep in mind that this is the Dow futures chart. That's where you're going to see you seeing it moving back and forth a little bit. So the fact that it's here, it closed here, 842. The actual Dow is at 840, 883. So you have to add 40 points to this roughly in order to arrive at the actual number. All right, is that clear? And so one of the cheapest ways to play this Dow 20, the Dow 20,000 type of magnet this week before Christmas is to play the DJX. They're about 60 cents, 70 cents. They move with the Dow. They were up to 76, 77 cents. They closed around 62 cents. These are the 199s. I've been talking about it. The high for the day was 78 cents. The low was 60 cents. Percentage-wise, that's a nice swing. So that's what I think, and I thank Dano for bringing that to my attention, because a long time ago I used to trade the DJX, but that is the sort of the cleanest way that you can play the Dow if you're doing it through options trading and want to keep your costs low. So this is clear. Doesn't mean we can't come to the bottom of the channel. Now, what things get really dicey is when you have this powerful support level down here at 19,752, which correlates to 19, and add 40 points to it, correlates to about 19,942. I'm sorry, 19,792. My apologies. When you fall, if the market falls here, can hold this, falls here, can hold this, and falls here, that gets dicey. Because at that point, you could, you have this whole move here, and that's called range trading or channel trading, that you need to cover. Is it possible? It sure is. Anything is possible. So given the fact that this is your entire range that the Dow is trading in. Now this has been the lower part of this has been satisfied from a technical parameter standpoint. So that's been satisfied. So it doesn't necessarily need to be satisfied again. We have multiple supports here. and most importantly, the channel is holding. If it breaks this, then all these come into play. It's really as simple as that. So you got to at least look at it on your own side. Like I say, monitor your own screens and track what's going on. And it's not like I just put out a couple of charts and go away for the day. I'm constantly engaging with people. I'm constantly updating the charts. So you don't have much to do other than use those 3 brain cells that are left, right? All right. So this is where we are with the Dow. Let's take a look at the S&P 500, which is actually more interesting. How about that? So this is a very specific chart, and it's really not that hard to understand. We are in a triangle squeeze. How about that? Triangle consolidation, diagonal, whatever you call it. A pinched Bollinger, which is suggesting, as you can clearly see, I don't need to help you see this, that this pinched Bollinger is going to resolve one way or the other, up or down. Now, some of the broader macro political stuff has finally, and thank God, been removed. The Electoral College. We have an official precedent. So that has been removed. Markets hate uncertainty. You never know what might happen at the last minute. So that's been removed. Doesn't mean there can be other international or domestic issues, events out of the blue, black swans that can hit the market. But let's stick to what we see here. So this is a very constricted. So you have a very constricted pinch Bollinger. Either it's going to go like this, past this 2272 level, or it's going to break below this consolidation triangle and fall down here. I put these little markers here the other day. If you look at, and again, we have a new free trial member, and welcome, Yuji. Do come into the chat room tomorrow if you have time. Great people here. Everyone willing to help. You understand and sort of navigate the Clueless 8 trading methodology. Is that this, I put a chart on Friday saying these are multiple buy zones, multiple support zones, multiple buy zones. I was correct, because since Friday, we went higher. More importantly, you see what's going on here. And this, at least to my naked eye, looks like it wants to squeeze up, like a toothpaste, right? Looks like so the toothpaste is getting squeezed. And the first initial burst should be to test the upper end of this trading band, which is in the 20, these are E-minis. So the E-minis closed at around 2262. I'm sorry, the S&P closed at 2262. The E-minis right now are up about $1.50 after hours. That's why you're seeing it at 2261. So in reality, the S&P currently is basically at 2265 or so. Bottom line is 7 points higher. The E-minis need to break out, the SPOOs, as they say, need to break out over this range. Once it breaks out over this range, and remember, this is one depiction of the chart. I've shown multiple different views of this because there's many different ways you can measure this. Once it breaks out, that's when you hit that 2280 level and possibly head towards, and that's when you get that kiss towards 20,000. This breakout is what the longs and the bulls are hoping for. The bears are praying for a breakdown below this powerful support level of 2247 to 2250 roughly, which is roughly about 2254 on the S&P 500. Hit another support zone, a weak one, this one down here, and if we break this, it's going to be a nice little free fall. You do not want to be long. You certainly want to be short if we break the 2250 level or so on the S&P 500. All right? It's not that hard to understand. It's right there. See this 4 candle move here that took 5 candles. 1, 2, 3, 4, 5. that occurred back around the first week of December? Nobody expected it. Nobody. Everyone thought, okay, the consolidation channel is just going to keep on going down. And then I saw it turn around. I said, oh my God, this is happening. And once you get these type of moves, the market does glide higher. It doesn't go in. Does this look like a straight line to you? No, it goes in waves. And then it just massive sell candle here at around the 14th. Remember, middle of the month, we always get volatility. Everyone who's been with me knows that very well. Middle of the month, you have a big tactical reset on many different market makers books, algos, which basically doing a lot of chop. It was a Fed meeting, all that good stuff, right? So you did that. Now we're past that hump. Now we're on the 19th. We are past the middle of the month. And generally, as we are now closing the window for the year, you have window dressing coming in front of you, where portfolio managers sprucing up their portfolios by adding beta, in other words, high momentum winners to increase their alpha, which means increase their returns on their portfolios. Because believe it or not, a lot of hedge funds, a lot of them are still underperforming the market. The market's up 8, 9, 10%. That Russell 2000 is up 14%. Those bozos are still up 6, 7%. In some cases, negative. Believe it or not. So they got to do something to preserve their jobs, to show that they have still at least one brain cell left in them before their big pension funds and clients say, you know what, see you later. I'm taking all my money out next year, and you guys are charging me a fat fee, 2% to manage 20% of the profits, and you're showing me negative returns to flat returns. So pension fund managers, the money management complex on the mutual fund side and on the Wall Street institutional side have to deliver something. So they chase the same old stocks, the Amazons, the Googles, all the winners. So there's a fundamental basis for it. They just do it on a momentum-driven end of the year type of thing. But there are other stuff, which can come into play, but that's the main thrust right now, just so you all understand. The money management business is a serious business. They don't give a hoot what retail traders think about valuations, because retail traders can't even read a proper income statement or an earnings report, even if you paid them. They just look at the PE. I've always mocked it, and I'll mock it again. They don't even understand that PE is no longer relevant to high growth stocks. It's PEG. And there's a lot of other factors involved in it too. So good word of advice. There's only word of advice I'll give you, because I don't advise, I suggest when I do my trade alerts and stuff, right? But only one of good advice is stop being an analyst. Stop being a central banker and stop being an analyst. You've heard from me before. You hear from me again. Just try to be as simple as possible. Look at the tactical levels and figure out. Back to the charts. So this looks like a squeeze, and I expect it to go higher. If we break these support zones, see you later. Stay short all the way down. Let's move on. So this is the actual representation of the S&P of the E-minis right in front of you. Remember, sometimes in trading, you just have to look at first glance. What is your brain telling you within the first 2 seconds is what you go with. The more we tweak, the more we analyze, it becomes analysis paralysis. And you all know that better than I do, because a lot of you are really analysis paralysis. Well, that's something you can, you keep on doing it, and eventually you get so sick of it. You change. People change when they're really sick of themselves. Comes from personal experience. So the bottom line is that if you're not sick of yourself and what you're doing and your performance, then you'll never move on to the next stage. Remember that. So saying all that, at first glance, it's, at least in my eyes, this wants to go higher. You can see multiple green candles, and you're seeing this constriction here on the pinch Bollinger and the consolidation triangle, and it looks like it wants to push higher. So you got to go with that. You got to go with it. You got to go with your first gut feeling. Could be wrong, but most of the times it's going to be right. Remember that. Let's take a look here. 1 second. Now take a look at the S&P 500, a clean fifth grader version of a chart. like I like to say, right? What does this look like? Does it look like it's going to completely break down and die? No. First glance says it wants to go higher. 2280 is the mark. This is the band that is trading in, a wide band. The low in the band. Hold on 1 second. It's some sort of ads coming in. Hold on. Stay on. I'll be back in 2 seconds. I think I got rid of those some stupid junky ad coming out of Google Ads. But all right, let's get back to it. So this is first glance parameters. This is the dynamic momentum index. Basically, it's just another derivative of the stochastics, and it's a momentum index. How about that? And you can see here, I showed you what happened here from the lows of 2190. Similar stuff happened here. Despite the choppiness, despite the volatility, the tight range volatility, you are seeing a upward momentum on the dynamic momentum index. So internally, that's a go. A real blast up, for whatever reason, would jettison us up towards the 2300 level. Do I expect that to happen this week? Nope, I don't. I think it's a low probability trade. Can it happen by the, excuse me, can it happen by the end of the year? Yes. Because you're talking about 30 points. 30 points times roughly 5 or 6 S&P. 30 S&P points is roughly 150 to 200 Dow points. We can get 200 Dow points from here? Sure we can. So that's number one. On the same vein, if we see the, if we pull in the Dow Jones Industrial Average here, this is your actual Dow Jones Industrial Average. Let's draw this out with our Clueless 8 audience in attendance. There you are. There's your trading band. It's not that hard. Real easy to determine. Tough when we have positions because they're moving back and forth. Like, we're not selling at the. Some of you are not selling at the upper end of the zone. They're holding on. They're back down. I know it's frustrating. Of course, it's frustrating. I go through it myself every single day. But I'm showing you what the range is. The range is 19,745. Upper end of the range is 19,971. 965. Breakout, one way or the other. Up like this or below. That's all you need to know. If you break this level here, there's an 80% plus probability you're going to fall lower, a couple of hundred points. And that's 745. So you're talking at 140 points from here, where we closed at today, is your major, major danger zone. Could be a buy point because it was a buy point there. So we have to see how it reacts at support in order to determine whether the market is a full-fledged short or not. That's your Dow Jones. There's your trading range. First glance, looking at the dynamic momentum index on the 1-hour charts, it's kind of flattish, but the upward, let me draw this out. Again, just like the RSI, any reading below deep oversold reading when we got those two massive, one massive and the second doji, but still looked massive at the time that was going on back on Wednesday, is the Fed day. And I did say nothing changed. Look it up. Many of you took advantage of it. And the next following day, you minted money. You all know that. A lot of you were freaking out. I showed multiple charts on my Algo HFT platform, the quad platform. This is obviously a very simplistic platform. So anyway, TOS, at least for this chart. And I said, deep oversold, slow stochastics, all kinds of good stuff. People who bought in, the following day, we were up a couple hundred points. Memories are short, but you all remember. So the point is that when you get down, whether it's a full stochastics or fast stochastics or slow stochastics or RSI or dynamic momentum index, whatever you use, I generally tend to use stochastics a lot. I use this on some of my trading charts. You get down towards that 14 level, anytime below 30, I mean deep below 30, you got to buy with both hands down, or at least with one hand, not sit there like a frozen sheep and then watch everyone else make money, or the few who got in, and you sit there and say, oh God, why didn't I do it? Because that, oh God, why didn't I do it, happens way too often for some people. And eventually it just erodes, and that out of the 3 brain cells, there'll be 1 left. And that's a very dangerous quantity to have in order to be a trader. In order to be a trader, you need at least 3 brain cells. I'm serious. Okay? So if one's a little bit lazy, the other 2 are working for you. If you have just 1, you're finished. You think I'm kidding, but I'm serious. So the bottom line is that so far, looking at this here, the uptrend is still intact. So higher probability that we move higher. It's going to be chop, it's grinding, but looks like it's going to break out over this, and 20,000 is right above this breakout level, which we see. All right? Now, let me just show you one other thing here on the New York McClellan oscillator, which is available to anyone on stock charts, dollar NYMO, but I structure it a different way so I can do the readings that I need to do. Because it's not the charts, it's how you structure it, is what gives you the view of what's going to happen. That's called predictive game theory. It's a fancy name for saying that I use the tools in hand, structure it in a way so I can read it better. Really simple. So let me walk you guys through this. So here you have the big deep minus 75. I mean, I've always said below minus 40, below minus 50 of the McClellan oscillator, you literally know the market's going to rip. It's going to be a face ripper rally. I don't care what the crisis is, because you hear a lot of guys on the other forums, without naming those other forums, we're like, oh, this thing is happening, it's going to kill the markets. Bull crap. At one point, market gets oversold. If it truly is going to be a bear trend, it's going to first go higher, called the reflex bounce, known as the dead cat bounce, and then it's going to give in again. So point is that you can make some serious money of the dead cat bounce too. So this was your post-election. This was actually before elections, the 9 days that we were down. People remember. We got down to minus 75. So it didn't matter what the election results were going to be. Whoever won, we would have rallied. Maybe not to this extent that we did with the Trump effect in place, with the stimulus and all that talk and the change in business sentiment and stuff going on. But we would have rallied because we were so deeply oversold. We rallied. We went from minus 75 to plus 59. Everyone see that, right? On their screens? Yes? No? Maybe?
Yeah, I see it.
Okay, good. And then we came down. We fell Friday. I mean, this wasn't Friday. This was early December. And then we rallied off again. Came down. This was Friday. We hit pivot because I structured by putting the right parameters that I need to see. So let me just remind you what the parameters are. Here's your pivot. Very simple. Above pivot, good. Below pivot, bad. How about that? Can't get anything wrong with that, right? So pivot's a pivot. You use that as a jumping board. So if you fall below the pivot, boop, you go down. You fall above the pivot. Now, this can happen in 5 minutes. This can happen in 15 minutes. This can happen on a daily basis. But we use that all the time in our trading, especially in the index trading. The pivots are key. S&P, believe it or not, as I'm looking on one of my other screens, is nicely above pivot right now. The pivot was 225.26, the SPY. The SPY right now, after hours, because it's real-time stuff going on, is at 225.86. I'll take that. So bottom line is that here's your pivot right there. that P. Resistance, 74. Now, you don't need to know the numbers. I'm just showing you the levels. This is the higher resistance, R2, which is like, if we get up here, R2, I've never seen the, I can't think of, I've seen the McClellan oscillator, the shaded area, go up to 100 plus. If that's the case, please proceed to short the market with as much money that you have, because at that point, it's maximum euphoria, things are totally out of control, and you will make a crap load of money shorting the market. Has it gone to, I've never seen it gone to 100. Most I've seen is 63, 64, whatever the case. So, but let's try to read into this chart and make a predictive forecast of what's going on. Let's start off with the fast stochastics. The fast stochastics are clearly giving us a buy signal. It's a double bottom crossover. Double bottom crossover, similar to what we saw here. Here's the interesting part. We got this deep oversold on the fast stochastics with the market way higher than where we were back on November 9th. That's a positive divergence. We are all the way up here, but the stochastics are at the same levels oversold as they are. I like that. That's good. That's known as a positive divergence, where the price is higher, but the internals have come down to the same levels they were at when we were down 1,000 points from here. The pivot is what we're holding. Notice this red lines here. This is your Bollinger Bands. You can see those two red lines. Let me clear out this screen a little bit. Look at the two red lines here. And this is not rocket science, believe me. Here's your Bollinger Bands. Look what we're doing. We are in the Bollinger, on the lower end of the Bollinger, bouncing off pivot. That's all I need to know for now. We're bouncing off pivot. The Bollingers are still sloping up. I like that too. We also like the fact that the RSI is creating a double bottom. Just the way it created a double bottom when we rallied like a monster after the initial shock of the first week of December. Right there. Okay. Is it possible that we shoot up and hit 74 again or 61? Who knows? We could. It's R1 is the first resistance. Maybe the machines want to take it up there. If that's the case, we're in for a 300-point rally this week. I doubt it. I think we're going to hit the mid part, this dotted line here, and that's where we're going to ease. Now, why do I say that? I say that because it doesn't take much for us to go up 150 points, hit 20,000, overshoot a little bit, make the headlines, get mom and pop really happy for Christmas, to go out there, spend a lot, because that's really what happens. Dow 20,000, whoopee, you know, and then bring the market down sometime by the middle of January or the first week in January, or even some selling towards the last 2 days of the month, which generally when the markets sell. So this is what's telling me. If you look at the MACD, it's starting to slope down. That means a general weakness that's in the market. In other words, the fewer stocks are going to make newer highs, while most stocks will basically making lower highs. Fewer stocks will be making higher highs. That's a negative divergence. So this is telling me that the market is in a process of weakening on a slightly intermediate term basis, but short term, it wants to bump a little bit higher based on different readings. If we see this McClellan oscillator Bollinger completely cracked down and this turned down like it did here, all bets are off. If you start to see this McClellan oscillator shaded area, and this is updated as of tonight, today's action, start to go red like it did here, you better stay out of, you better stay out of the long side. You got to short the market. We see none of that happening yet. In order for this to turn red and go into the red and into the started to go take a dumpster dive, you need to have a 200-300 point move down on the market to push it down. Till it happens, it's moving higher. Okay, let's take a look at put this out. Now, as a reminder for newer people like you, I guess Eugene's left. Okay, for everyone, in that case, you have a lot of good, powerful charts that you can use on your own end using investing.com, which I'm finding to be an extremely useful tool. Stuff like this, which is based on a 15-minute, for example, you can actually do it. I mean, you can draw like this on your iPhone, but you can actually track it in your iPhone on the mobile application, which I find to be very useful. But just on your laptop or on your desktop, whatever, please put this investing.com. But it's going to help you a lot because it's very, very visual, and it's showing you how things are moving in between a certain range. So just because we had a big candle move, you see the reversal candle, all kinds of good stuff. Do start tracking all the ones that I put out there. Individual stocks are trading within a very sharp, tight range. The Googles and the Apples, which tend to deliver some nice moves and profits, have to be you have to take into account what levels they're hitting. They don't necessarily have to go all the way to the levels that we are projecting. That would happen in an optimal market. For example, I'm hoping Google gets to 825. The lottos, that's why we buy them really cheap. Maybe it gets to 825. It's showing, but in reality, it's also trading in a channel where the upper end of the channel was hit today, as I showed, at around $815.22 at around 2 p.m. and then it pulled back to the mid channel, which I showed also, and then so it's up to you to figure out whether or not you want to take some profits at that 815 level, or you just want to hold your nose and hold it all the way to 825. Like I said, that might take a couple of extra days, might take next week. I don't know. But Google normally tends to move very fast. Goldman is another beautiful chart on the algo HFT thing. You can see that clearly what's going on. And I post this for people who are not using the quad system. Obviously, I'm posting this repeatedly so you can see that. I'm also posting where resets are in progress. Now, this chart at the end of the day looked pretty good because it actually hit the bottom of this channel right there and bounced up. And we are right here somewhere right now. Okay? So again, another case of a well-structured chart that I drew, and it hit exactly that level. Now it's bouncing up. What we needed to do on a powerful move up is to take out the blue line here, the 2264, and get up to the upper channel, maybe sort of zigzag around a little bit and bust a move up here. 2272 would be a powerful sell zone. Because that was a point of maximum supply and a point of maximum reversal, as you all can see. So don't get all excited at 2272 unless we, because it is going to pause there a little bit, whether it's for 5 minutes or an hour, I don't know. So this would be fantastic. But so far that you can see it's basically the reason I draw these channels because it shows you on a segmented basis as to how it's moving. Just by looking at this chart without the channels, you'd be like, oh my God, here we go again. We're going to 2250. We're going lower because that's what it looked like. But because I have the channels in place, you see how amazingly the algos are actually tracking those exact levels. So that's pretty much what I have to say. I don't want to keep on going on and on. I'll entertain 1 or 2 questions and got a bunch of stuff to take care of. And so this should give you a clean idea of what's going on. There's no substantial news in the market per se. The Yellen didn't say anything, to really rock the boat. And the financials started to pick up. As you know, Goldman picked up nicely. This is actually Goldman's chart on a different sort of structured way. And you can see what's going on. Automated buying came down 1, 2, 3, 4. Busts a move over this downtrend line here. Maybe it retracts the whole thing back and goes to 246. Goldman, it's a tough one to short. Internals are showing well. They're curving up. So this one looks like a good bet. Seems to be buying all day long overall since, or at least since 12 o'clock. You can see that. And of course, you see that more clearly on your Thinkorswim platform or TradeStation or whatever that you guys use. Remember, you have to use one platform that matches my charts. Otherwise, you're going to be lost. Questions, please, if anyone has any. That's Google in front of you. It's trading in a band. This is the main consolidation channel, and that's between 811.66. You can see that right there on the right, and upper end is 824. So on this 1-2, you can see that there's a good possibility that the stock, which basically had a reversal hammer off the downtrend line, this is very positive. This is very positive. 4 blocks up, 4 candles higher. I wish there was another big candle up here, but pull back, because the market weakened towards the end of the day. But very, very possible that it hits that 819 level, which seems to be the first. That's why you have a green line here, right? Resistance level. But if it blows through that, 824 is very, very doable. Basically, this is the range Google to travel in, and that range is roughly 12 points. Any questions? No one? Corey? Danu? Go ahead.
How about Bank of America? You have anything on that?
Sure, I do. I actually have Bank of America in here. The thing with the banks are that and this is the frustrating part about it, is they move sideways, and all of a sudden, without any warning, they just bust a move. So very difficult to track them on a exact basis as to what it's going to do. They're they're much harder to forecast, especially Bank of America, which moves in pennies, right? They are much difficult to forecast, Corey, than, let's say, Google or an Apple or one of the bigger stocks. But saying all that, I have BAC here. And I have those lotters too, which are like a penny and a half. I paid like I kept on lowering the cost down because we're playing a penny stock. So now my cost is down to about 5 cents from about 14 cents. And so hopefully, you never know, because I've seen Bank of America, we've seen that. I mean, those pennies blow up into 8-9 cents real fast. So this is really Bank of America, Corey, in front of you, okay? You got 23.40 on the upside. You got 22.21 on the downside. Below 22.21, we are in trouble right here. Now keep in mind, because it moves in cents, and it can come down, but this is where we are. We are trading in a range. You can see that. There you go. So we are obviously coming off the lower end of the range. That's the good news. We will find resistance here at around the 23 level, because that is the back test of the uptrend line, this uptrend line. Okay. If we can get up above that and do a pattern symmetry, which is basically retracing this down move with an exact up move, and of course it's going to be choppy, just the way this was choppy on the way down, then you're looking at 23.40. Above this rising wedge is when we get towards that 24 level. So I don't know what this ad keeps on coming. Hold on 1 second. Hold on. Okay, I'm back. I don't know where this ad keeps on coming on. I can't find it. So all right. So this is what we are. But honestly speaking, it's just going to wake up and just move up towards that zone. It looks like that. Very, very hard to predict. But there's nothing wrong with it. It's really a swing trade. Bank of America is really a swing trade, despite the fact that those lotters really move on days that the bank is higher. Does that make sense?
Yes, thank you.
Yeah, so that's basically it. I mean, bank, like I said, that's why they're lotters. They're so cheap. Now, if we take a look at the daily on Bank of America, this is where we are. We have had, so this is where we are. I really can't say anything negative about it, because it's really not doing anything negative. It went up hard. It created a consolidation or profit-taking zone, right there. And if I remove this, I mean, if you draw the channel, then you can go like this. Let's see here.
That's Google.
Oh, that's Google. My apologies. What happened to the Bank of America? Hold on. Oh, there it is. So, sorry about that. So, there. So there's your daily on the stock, all right? And when you look at the daily on the stock, you can see how sharp it moved. So it's actually not a, there's nothing wrong in this. As long as this band holds, it's going to move sideways. That's it. I think Bank of America at this stage is going to move sideways a bit, and before it decides to take out the 2360 level or so, and that's really what. Yeah, I haven't traded Nvidia right now. You know, yeah, I'm not even charting Nvidia. Great stock. Great stock. I've showed it, but yeah, unfortunately, I haven't had an opportunity to trade Nvidia. Great, you know, great company. Stocks at new highs, probably going higher. But yeah, that's answered your question. Xita had asked whether I posted Nvidia chart or traded the stock. No, I haven't. But I will put up a chart on Nvidia just so that you guys can see where it's going. In fact, I can just put it up here. So Corey, that answers the question. It's a trading band between, on the daily, it's a trading band between 2340 and 2219. So you're talking about $1.20. That's the range that it's trading in. But so far so good. There's nothing wrong in the picture. But as an instant gratification, you only get those on the lottos when the banks all move on a certain day. Fair enough?
Thank you.
Yeah. Let's take the quick look. Oh boy. This probiotic ad is stalking me. Hold on.
Maybe it's telling you're having too many CMG.
Yeah, no, I am not. Thank you for asking. No. We just have, one of the best thing other than yogurt and stuff is they have, what's it called? Kefir, you know, that the yogurt drink. That really takes care of all your probiotics. Okay, so NVIDIA chart is actually very powerful. The question is, where is it going? I have no idea. This is a 1 month chart. Holy cow. So basically, this is a 1 month chart starting over in June. So it's literally a straight line up. I mean, obviously, funds are buying the crap out of it. Maybe somebody's going to buy this company. I don't know. But there is absolutely no way to determine where the stock is going. And that is the God honest truth. It's going higher. I just don't know where it's going because there's no way I can physically measure. I mean, I can actually put in some measurement stats in it other than do this. 1 second. Watch this for a minute. No, where is it? Where is it? Fib. Nope. Okay. So watch this. This was the previous high back in 2009. So this is what you call off the charts. Wow. So the next level comes at 137.26. That's pure Fibonacci retracements on this runaway type of multi-year move. The next resistance comes in at 137.46. Is that going to, it goes up 35 points from here in a couple of weeks? I doubt it. I really doubt it. But who knows? Maybe it's, maybe somebody's looking to buy it. In that case, it will go to 135. But that's the only way you can determine on a long-term basis where the stock is going. 137 and 160. So that would be, sort of the only way to determine. All right, guys, I'm going to put this up on YouTube. I got to run, take care of a few things. I shall see you guys tomorrow. Corey, keep the faith up. Let's do this together. And let's try to hit a couple of moves here. Let's get that burrito thing moving again. I took one round of profits. The next one I had a little bit in. I still had half in there, a little less than half in there. So that was slightly down. But let's try to get one of those days, guys, where you have a broad rally in all sectors, because the segmentation and the bifurcation of all these different sectors is really driving, and rightfully so, many traders nuts, because it just doesn't seem like on a systematic basis that all the powerful sectors where the stocks really move, like biotech and large cap high tech, the high momentum stocks and banks, moving in tandem. It just seems like way too many patches of red and then bunch of greens, and it does get frustrating, believe me. And I agree with that thoroughly, but hey, what can we do? We're just a hostage to the markets. Sue, you have any questions? No? Okay. I'll see you guys tomorrow. Have a great evening. Hopefully this quick update helped, and let's keep our fingers crossed. We'll go from there.
Thank you.
Thank you, sir. Bye-bye.